In this recording, I will discuss weighted average marginal cost of capital and optimal capital budget. Let's start with the definition of marginal weighted average cost of capital. Marginal weighted average cost of capital is simply the cost of the next dollar of capital to be raised. Another term that is used to imply the same thing is marginal cost of capital, or simply MCC. When the range of capital raised does not dramatically change the risks taken by capital providers, component costs of capital should not change. However, issuing costs and empirically verified downward sloping security demand curve may cause jumps in the weighted average cost of capital. These jumps in WACC are called breakpoints. So we will explore this point in the next couple of slides. If you look at this chart above, for this firm, the weighted average cost of capital is constant for a range of capital that is required or raised. For instance, up to $500,000, the firm's weighted average cost of capital remains around 11.77%. But then when we exceed this amount, that is any capital that is raised in excess of $500,000, causes a jump in the weighted average cost of capital to 12.394%. So we are talking about this phenomenon, that is, as the amount of capital that is raised grows, we experience similar jumps in the weighted average cost of capital curve. So let's look at this simple example in here. Suppose ABC Incorporated's capital structure is composed of 25% debt and 75% equity, and ABC Incorporated can borrow up to $1 million at 6% interest rates. But if the company pursues any amount that is larger than $1 million, particularly in the range of $1 to $2 million, the debt cost may increase to 8%. So there is a 2% increase or jump in the ABC's cost of debt for amounts that exceed $1 million. So this causes a break point in the weighted average cost of capital. So this break point can be calculated by using the following simple formula. So a break point is equal to the dollar amount of component capital where the kink occurs or the jump occurs, divided by the weight of this component capital. So in this example, the component capital that we are talking about is debt, and the cost of debt changes right after $1 million mark. So that is the size of the dollar size of the component capital where the jump occurs. So we use that amount in our nominator and divide that amount to the ratio or the percentage of the debt in the capital structure of the firm. So when we do that, we get $4 million. What does that mean? That means that up to $4 million of capital that is raised by ABC Incorporated, the change in the cost of debt does not cause a jump in the weighted average cost of capital. But once we exceed the threshold of $4 million, which 25% of that amount is going to come from debt, we will incur a higher cost of debt, which is going to push the weighted average cost of capital to a higher point. So with the understanding that the firm will preserve its capital structure, assuming that it is the optimal, so when it raises the next dollar, it is always going to do this with 25% debt and 75% equity. So with this assumption, the firm actually can raise up to $4 million without any impact from the cost of debt in its weighted average cost of capital. So we are going to use this approach to determine jumps that occur in the firm's weighted average cost of capital. It is also possible that, for instance, the cost of equity might not change, let's say, up to $2 million. That implies that 2 million divided by 0.75 will give us the amount of total capital that the firm can raise without incurring any changes in WACC due to changes in the firm's cost of equity. So we're going to use this principle to determine the breakpoints in the weighted average cost of capital and to see how the firm's weighted average cost of capital evolves over different amounts of capital that is raised. So as I mentioned in this example, cost of debt changes at $1 million. And since the ratio of the debt in the capital structure is 25%, that implies that WACC actually is not going to change up until we raise capital in excess of $4 million. So up to $4 million, there is no impact on weighted average cost of capital that is coming from the cost of debt. But once we hit this threshold, the cost of debt is going to increase, and therefore there is going to be a kink in the weighted average cost of capital. So we're going to have this step function in the weighted average cost of capital as component cost of capital changes. We simplify the case in this example. It is possible that other sources of capital might also incur similar breakpoints, and then we will have to figure out costs within the ranges of those breakpoints. So let's look at this example, access good example. This access goods target capital structure is shown in the chart below. So these are the market value of each component capital. These are the market values. So the firm has $1.69 million of market value of capital that finance its assets. 45% of that capital is debt, 2% is preferred stock, and 53% is common equity. So the cost of debt currently is 10%. Cost of preferred equity is 10.3%. The company's tax rate is 40%. Company shares right now are sold at $23 or traded in the market at $23. And the company's dividends are expected to grow at 8% rate. And the last dividend that is paid by the firm is $1.15. Obviously, this information that is provided here will be used to determine the cost of equity. So if you look at each component in Access's capital structure, the cost of equity with the given parameters is equal to 13.4%. And as we mentioned, 53% of the capital is coming from equity. And the company's cost of debt is 10%, and 45% of the capital is coming from debt. And cost of preferred is 10.3%, and 2% of the capital is preferred shares. Based on this information, we can calculate the weighted average cost of capital of Access, which is equal to 10%, given respective costs and the weights in the capital structure. Now, the question is, will this weighted average cost of capital remain constant for all ranges of capital raised? As we mentioned, as the amount of capital that is raised grows, the cost of capital also trends up because of a number of factors. One of them is obviously the issuing cost, but also there is an empirically verified downward sloping security price curve, and that also contributes to the increasing cost. So we will talk a little bit more about that in a minute. So could Access raise an unlimited amount of new capital at 10% cost? Obviously, the answer is no, based on what we indicated. So as a company raises larger and larger sums during a given period, the cost of that preferred stock and common equity begin to rise, and this occurs as this occurs, the weighted average cost of capital of each new dollar also will increase. So at some point, the cost of each new dollar will start to increase. So we need to figure out at what point will this occur for this company, Access. So based on market value balance sheet, we know that the company has $1.69 billion of capital invested. The capital structure suggests 45% debt, 53% equity, and 2% preferred shares. So when the company raises common equity, the new common equity will come from two different sources. One of them is the retained earnings intended to flow back from this year's profits. So not the retained earning that is already invested, but the retained earnings that is going to come from this year's profits. And also the new issue. If the retained earnings are not sufficient, we might need to issue new equity, and obviously that will have a different cost, as we're going to see in a little bit. If the firm uses its retained earnings, since the company is not going to incur any flotation costs, and also in the market it is not going to see a downward sloping curve because of new issue of equities, its cost of equity will be 13.4%. But if the firm attempts to raise new equity, the cost of equity is going to jump to 14%. Now, how did I calculate this? There is no calculation involved in here. We are making an assumption that the new equity is going to be about 60 basis points higher, and this could be attributed either to downward sloping curve or flotation cost. So we will take this as a given, and we will accept that the new equity will cost higher than the existing equity or the retained earnings. So this is not an unreasonable assumption, by the way. So if you look at the component cost, as we talked about, the cost of debt is about 6%. Effective cost of debt is 6% because nominal cost is 10%. There's 40% tax rate. Effective cost turns out to be 6%. The cost of preferred is 10.3. Common equity is 13.4. And based on that, we have a WACC of 10%. But if the amount, if the company issues new equity, as we know, the cost of equity is going to jump up to 14%, although the other component costs are not changing. This is going to cause a change in the weighted average cost of capital to 10.3%. So if the company issues new equity, the weighted average cost of capital is going to be about 30 basis points higher than the previous one. So then let's look at how much new capital can Access raise before it exhausts its retained earnings and is forced to sell new common stock. Meaning that, I mean, how much total capital we can get before we issue new equity. So this actually implies also when there will be an increase in the MCC schedule. So if we assume that the company expects to have a total earnings of $137.8 million, and the firm has a target ratio of 40%, 45%, target payout ratio of 45%. This means that 55% of $137.8 million is going to be retained. And as a result, we will have about $75.8 million plow back as retained earnings. So we also know that the company's capital structure is as 45% debt, 2% preferred, and 53% of common equity. So for every dollar that is raised, 45% or 45 cents will come from that, 2 cents from preferred, and 53 cents from common equity. So based on that, if you have $75.8 million of retained earnings, this could be utilized or deployed as equity. That means that, let's say, if we have X amount of capital that we raise, 53% of that is going to come from equity, and that amount that can be deployed without issuing equity, new equity issue, is $75.8 million. So this means that we can raise a total of about $143 million without issuing external equity. So again, the total amount of capital required is X, and we know that 53% of this has to come from equity. And the equity amount that we could deploy without issuing external equity is $75.8 million. This means that we can raise a total of $143 million without resorting to external equity issue. So this is actually $143 million is a break point. If the company requires a capital budget in excess of $143 million, it will have to issue new equity, and its cost of equity is going to jump from 10% to 10.3%. So if we show this in a graph, up until $143 million, the cost of capital is going to be 10%. But if you require any amount of capital in excess of this, the weighted average cost of capital is going to jump to 10.3%. It is also possible that for larger amounts of capital, we're going to see similar kinks or jumps. The weighted average cost of capital is going to increase. Here, you see this solid line versus these dashed lines or a shaded area. This simply implies that the required rate of return is not a certainty. So we can estimate these with some level of precision, but not exactly or with 100% precision. So it is always good to think about a range of cost that is going to be incurred for these determined breakpoints. So depending on the flotation cost, market conditions, these rates or the required rate of returns could be lower or higher. So as we indicated, $143 million is a break point in the MCC schedule, or marginal cost of capital schedule. As I mentioned, there could be other breaks, particularly if the cost of debt or cost of preferred shares might change for larger amount of capital that is raised in the market, either because of issuing costs or because of the downward sloping security price curve. So these will have implications on weighted average cost of capital further. So in this case, we sort of simplified the case and limited the jump that might occur to cost of equity. So there is an argument that the weighted average cost of capital should not change, provided that the firm's capital structure does not change. That is a reasonable thought. Actually, theoretically, it is correct in the sense that as long as the firm's risk profile does not change, its weighted average cost of capital does not change or should not change. However, in empirical studies, we have shown that the security market price curve is a downward sloping curve. This means that for larger amounts of capital raised, the price of the shares or bonds are influenced. When we add the flotation cost to that, we see a market difference in the cost of capital that is raised for large amounts of capital. Of course, these are also dependent on institutional and contextual factors. The deeper the financial markets are, the lower the price impacts of larger capital raising. But it is a fact that this affects the weighted average cost of capital. So now we are going to combine this analysis with an optimal capital budget. So what is optimal capital budget, and how the optimal capital budget comes into play in this context? So the cost of capital is a key element of capital budgeting process. As you know, we identify a set of available investment opportunities when we consider investments. We estimate the future cash flows associated with each project, and we find the present value of each future cash flow discounted at the cost of capital used to finance the project, and we sum the present values to obtain the present value of each project, and compare each project's present value with its cost, and whether we decide whether we accept the project or not. So in that sense, weighted average cost of capital is a critical input in this process. So an important issue that arises in picking appropriate point on the marginal cost of capital schedule for use in the capital budgeting. So what WACC should be used in evaluating investment projects? So here we can get some insights from the economic theory. As you know, the economic theory suggests that we should expand our output to the point where marginal revenue is equal to the marginal cost. At that point, the last unit of output exactly covers its cost, and further expansion would reduce profits. If we produce at a lower level, then we will have to forego some profits that otherwise could be captured. So we will use exactly the same insight in the context of investments. So the same type of analysis can be applied in capital budgeting. Here we will look at the rate of return that each investment opportunity provides, and we are going to adopt the projects as long as return on the investment exceeds the marginal cost of capital. So, for instance, in this example, we have four projects that are available at varying costs, and rate of return that is offered by these investment opportunities are given on this last column. So we have this investment opportunity schedule where we rank the project return on investment from highest to lowest, and then we look at our marginal cost of capital in consideration of, or also by considering the investment amounts. So in this example, for instance, the marginal cost of capital remains constant up to almost $143 million, but after $143 million, we incur a jump of 30 basis points. So as you see in here, project A, which has $50 million of cost, can easily be adopted. Its return on investment is larger than our marginal cost of capital at that range of capital expenditures. The next project has also $50 million of cost. So if we add that project, our total capital budget expense to $100 million, but our cost is still 10%. So this would also create value for our investors. When we reach to project C, we do expect or we experience a jump in our weighted average cost of capital, but the rate of return that is offered by project C in the next $80 million investment is still comfortably above our weighted average cost of capital. So that means that this would also be a value-creating investment. However, the project D has a 10.2% rate of return. If we push our capital budget in excess of $180 million, our cost is going to be 10.3%. Since the project D offers only 10.2% return, we would be destroying value if we adopt the project D. So in this particular case, we will adopt projects A, B, C, and C, and drop project D because at that point now we're going to incur or face value destruction. So this is the context of the marginal cost of capital in the capital budgeting process. That is, when we adopt investment opportunities, we consider the weighted average cost of capital, and we select portfolio investments based on the marginal weighted average cost of capital. So this is an issue that was not covered during the capital budgeting discussion, but this is an important concept. It has actually two important points. One is that the weighted average cost of capital does not remain constant for all range of capital raising. It starts to increase at some point. And also, when we consider capital budgeting with certain limits, we will have to consider the weighted average cost of capital. So this concludes this explanation or recording. There is another example included in the slide set, but I'm not going to go over it. If you have any questions, you can contact me.